Jerome Powell spoke, markets went tumbling, and many are wondering if this is now an official warning about a recession that's up ahead. Today, we're going to unpack the Federal Reserve rate decision. This was a major FOMC meeting. They provided the dot plots, which are indications about where they think interest rates will be in the next few years up ahead, but they also gave us the forecast about growth, unemployment, and inflation. Today, we're going to discuss these charts, we'll talk about the numbers, and of course, what these implications mean for us as investors and the broader economy moving forward. As you can see here, the S&P 500 went tumbling after struggling for a direction post Jerome Powell's speech. Of course, there's questions about whether we're going to be back testing those June lows. Will we break through it? And really, where are the markets going to head from here? I'd love to know your thoughts, so as we go through, drop in a comment below. And before we dive into it, make sure you've subscribed and turn your bell notifications on and hit that like button. So up first, Jerome Powell's speech. We know the market pays attention to Jay Powell. He's the Federal Reserve Chairman. He has the ability to move markets, but also obviously he's setting the direction as to where we'll be heading from here. The headline that came out of this speech this time was that Powell signals recession may be the price we pay for crushing inflation. As we know, of course, the Federal Reserve and central banks have got that dual mandate, focusing on price stability on one side, but obviously a full and functioning economy, as evidenced by the labour market on the other side. But essentially, a lot of the rhetoric and sentiment from this speech was more hawkish than we'd previously anticipated. The actual rate rise itself was about in line with expectations. Most consensus had a 75 basis point rise, but it was the forecast and the projections about where the economy will head that were more hawkish, and obviously were showing that the rate rises that will need to come through are likely to be restrictive and dampening and curtailing that demand. So as you can see here, some of the choice quotes that came through, the indication that the soft landing might be harder than was anticipated. We know 3 or 6 months ago, there was relatively optimistic lens about whether we could still achieve it. The discussion about the fact that this will be painful, but it's a pain that we will need to take to get this price stability back as quickly as possible. And also the fact that nobody knows whether this is going to lead to a recession, but if so, how significant that recession will be. So it was fairly concessionary from Jerome Powell about the fact that yes, a recession may be up ahead, but it's the price that we need to be paying. If so, ultimately, demand's going to be curtailed at every level, and this was a clear indication of that. As we talked about, the recession risks are rising. So this chart here is quite an interesting one. It really ties into the fact that Jerome Powell stated that below trend growth awaits ahead of us. Many people are wondering, economists are wondering, is this code for the recession up ahead? Obviously, they don't want to go out and say it and spook the markets and the economy. But as we can see here from the indications from the FOMC members, that they see the risks to unemployment projections weighted to the upside and to GDP projections and growth weighted to the downside. And so with the vast majority of them really fearful at the moment about both of these dynamics and how they'll be playing out. Obviously, the dot plots are always eagerly awaited when we get one of the dot plot meetings. This was one of them. If you're not familiar with what they are, the FOMC participants provide their assessments about where they think the interest rates will be over a period. So we get annual and then over the longer run as well. So annual over the nearer term. As you can see here, the median for 2022 is at 4.4%. Now, it's worth noting that that's got another 125 basis points or 1.25% from where we're currently sitting. Obviously, we only have 2 meetings to go. We've got November and December. So now markets are anticipating potentially a 75 basis point rise in November and maybe 50 basis point at December. But we'll have to wait to see because obviously the Federal Reserve want to continue to be data dependent to feed into that decision. 2023, a slightly higher peak funds rate at 4.6% before a moderation for 2024 to 3.9%. And they've got that longer term rate, that neutral rate, in and around that 2.5% mark. But obviously we're rising through what the market initially deemed as that neutral rate and moving into the restrictive territory quickly. And that's obviously been due to the elevated and sustained inflation pressures that we've seen. Having a look at the future forecasts. So these future forecasts are fascinating. We've got GDP and growth on one side, unemployment on the other, and then inflation. PCE inflation is the Federal Reserve's preferred measure of inflation. Obviously, as rates go up, you see unemployment generally tracking with that. And what was fascinating to see was the discussion about inflation and how long that's going to take to get to that back to that 2% mark that the Federal Reserve has highlighted as where they want to see it. As we can see here, it's going to take longer than anticipated. We've now got out to 2025, obviously moving back towards that level in 23 and 24, but not back to that level until 2025. A reduction in GDP growth and output over the upcoming years as well, which is indicative of the curtailing of demand that the Federal Reserve anticipates will come as a result of their rate hikes. And then obviously unemployment as well to tick up too. We are still in a relatively resolute economic stance at the moment, but of course, as these rate rises start to come through, we're going to see some demand destruction flowing through. We're going to see consumption start to go down. Consumers are obviously going to be questioning about what's going to happen. One positive is we've still seen inflation expectations not running out of control yet, but obviously the Federal Reserve wants to act quickly and swiftly to ensure that they're able to keep those maintained. In terms of where we're currently sitting, this is an interesting one. As we can see, inflation is runaway across many countries around the world. It's elevated. But what's fascinating on the other side is we've seen a very strong US dollar with that flight to safety. But the strong US dollar has implications for economic activity and output for a number of nations. We've seen the USD hit basic parity with the euro. We've also seen the Japanese yen being supported for the first time by the Japanese central bank in over 20 years. And these implications happen across emerging markets as well as developed nations. And so it's fascinating to reflect on the fact that other central banks are having this pressure being put on by the strong USD to obviously act in terms of their monetary policy decisions as well. Obviously, we don't know where it's going to end, but that is a fascinating thing to reflect on. And in terms of the summary of where we landed, if you are interested in more macroeconomic discussions, we'll leave links to those up above that you can check out. But overall, it was more hawkish than was projected. The officials cut the growth projections, raised their unemployment outlook, and it looks like J-Power for now is starting to concede that a recession may be up ahead without explicitly stating it. If you've enjoyed it, make sure you like, subscribe, and turn your bell notifications on. A big thank you for joining us. Check out another video, but for now, stay well and happy investing.